Imagine walking into a bank tomorrow and asking for a $180,000 loan to buy your first home. A loan officer smiles, reviews your application, types a few details into a computer, and a few minutes later says, "Congratulations, your loan has been approved." You open your banking app. Your account balance suddenly increases by $180,000. Now here's the question almost nobody asks. Where did that money come from? Most people have a simple answer. They believe the bank took money that someone else had deposited, then lent it to you. It sounds logical. After all, people save money. Banks collect those savings. Then banks lend them to borrowers. That's the story most of us grow up believing. But it's not how modern banking actually works. In fact, it's one of the biggest financial myths in the world. If banks only lend out money that already existed, something doesn't add up. Every year, millions of people buy homes. Businesses borrow money to expand. Students take out education loans. Companies finance new factories. Governments borrow billions of dollars. Yet somehow, the amount of money circulating through the economy keeps growing. Where is all that new money coming from? Surely governments aren't printing trillions of dollars every year. The surprising truth is that most of the money you use today wasn't created by a printing press. It was created inside commercial banks. That sounds impossible. How can a private bank create money? Wouldn't that mean banks could make themselves infinitely rich? Wouldn't they simply create billions of dollars whenever they wanted? The answer is both yes and no. Banks really do create money, but they don't create it without limits. And once you understand how the system works, you'll never look at your bank balance the same way again. To see how this works, let's follow someone we'll call James. James has spent years saving for his first home. After a long time, he has managed to save $20,000. Unfortunately, the house he wants costs $200. He's still $180,000 short. Like millions of people every year, James walks into his local bank hoping they can help. What happens next looks ordinary. But behind the scenes, one of the most powerful financial processes in the modern world is about to take place. And almost nobody realizes it's happening. Let's rewind to the moment James sits across from the loan officer. Most people imagine the bank employee standing up, walking into a giant vault, pulling out someone else's savings, and handing that money to James. It makes sense. If another customer deposited $180,000 yesterday, then surely that's the money James is borrowing today. But that's not what happens. In fact, in most modern banks, the vault is almost irrelevant to the loan process. Instead, the loan officer checks something far more important. Can James afford the loan? They look at his income, his employment, his credit history, his existing debts, his monthly expenses. Because the biggest question isn't, do we have enough money? It's, will James pay us back? Once the bank is satisfied that he can repay the loan, something remarkable happens. The loan officer approves the application. A few numbers are entered into the bank's computer system. Seconds later, James checks his account. His balance has increased by $180,000. No truck arrived carrying cash. No customer lost money from their account. No vault was opened. The bank has created a brand new deposit. This is the part that surprises almost everyone. When the bank approved James' mortgage, it didn't simply move existing money from one account to another. It created new digital money inside James' account. That new balance is real. James can transfer it, spend it, buy a house with it. The seller accepts it because the banking system recognizes it as money. This is why economists often say something that sounds completely backwards. Loans create deposits. The loan comes first. The deposit is created at the same moment. That's how new money enters the economy. Today, more than 90% of the money people use isn't paper cash. It's digital. It exists as numbers stored in bank accounts. Every time you check your banking app, pay with your debit card, or transfer money online, you're using digital money. And much of that money started exactly the same way James did, with a loan approval. Now let's follow James' money. The moment his mortgage is approved, his account shows an extra $180,000. A few days later, James buys the house. He transfers the money to the seller. At that moment, James' balance falls by $180,000, while the seller's balance increases by the same amount. Notice what didn't happen. The money didn't disappear. It simply changed owners. Now the seller has $180,000 sitting in their bank account. What happens next depends entirely on the seller. They might use the money to buy another home. They might invest it in a business. They might pay employees, or they might leave it in the bank. Whatever they choose, that money continues moving through the economy. This is why one loan can support many different transactions over time. The same dollars may be used to pay a builder. The builder pays workers. Those workers buy groceries. The grocery store pays suppliers. The suppliers pay farmers. One loan can ripple through the economy hundreds of times. That's why banks play such an important role in economic growth. When banks approve more loans, more money enters the economy, helping families, businesses, and entire communities grow. But if commercial banks create most of the money we use, who controls the banks? The answer is the central bank. Unlike commercial banks, it doesn't serve ordinary customers. It serves the entire financial system. Think of the central bank as the referee of the economy. It sets the rules instead of playing the game. One of its most powerful tools is the interest rate. A small change can influence millions of financial decisions. When interest rates are low, borrowing becomes cheaper. More people buy homes, businesses expand, and banks approve more loans. More loans mean more money is created, helping the economy grow. But if borrowing grows too quickly, prices can start rising. This is called inflation. Too much money begins chasing the same goods and services. To slow things down, the central bank raises interest rates. Borrowing becomes more expensive. Fewer loans are approved, and money creation slows. So while commercial banks create most of the money, the central bank controls the conditions that determine how much money gets created. And that balance helps keep the economy stable. Everything you've learned so far depends on one thing: trust. Every day, millions of people leave their money in banks because they believe it will be there when they need it. But what happens if that trust disappears? Imagine rumors begin spreading that a bank is in trouble. Customers panic and rush to withdraw their money at the same time. This is called a bank run. The problem is that banks don't keep everyone's money sitting in a vault. Much of it has already been lent to families buying homes and businesses expanding their operations. If too many people demand their money at once, even a healthy bank can struggle to meet those withdrawals. That's why governments protect bank deposits, and why central banks step in during financial crises. Their goal is to stop panic before it spreads through the entire financial system. Modern banking doesn't run on cash alone. It runs on confidence. As long as people trust the system, money keeps flowing. Loans keep being created, and the economy keeps moving. But when trust disappears, the entire system can be shaken. And that's why confidence is one of the most valuable assets in banking. So, do banks really create money? Yes, but they don't create wealth out of nothing. Every new dollar they create is matched by a borrower's promise to repay it. In other words, every loan creates both new money and new debt at the same time. Over the years, James slowly repays his mortgage. With every payment, the loan gets smaller. When the loan is finally paid off, the money that was created by that loan is effectively removed from the banking system, while the bank keeps the interest as its earnings. This cycle happens every single day. New loans create new money, and loan repayments gradually remove that money. That's why the money supply is constantly changing. It's always expanding and shrinking as people borrow and repay loans. The next time you check your bank balance, remember this: most of the money you use every day wasn't printed as cash. It was created when a commercial bank approved a loan. It's one of the most powerful systems in the modern world, yet most people never realize how it works. Now you do.